So welcome students to the series of lecture on fixed income. And in the series of lecture of fixed income, we are in a sub-series, which is the valuation of fixed income. And this is our session 2 for valuation of fixed income. Okay. In the last session, we understood that how we can project the cash inflow, how we can project the future cash inflow with the help of future value or face value, coupon, coupon frequency, and tenure of a bond or a fixed income instrument. Okay. So we took this example and we tried to project the cash flow of the bond where the face value of 1000, coupon was 8%, coupon frequency was annual, and the tenure was 5 year. At the end of the session, at the end of the last session, I asked you all that how much you would be ready to pay for any financial instrument which has these cash inflow 80, 80, 80, 80, 80 every year for 5 years, and at the maturity, which is 5 year, you will receive 1000. And I gave a very hypothetical situation. I gave a hypothetical situation. I said that you have to assume no inflation, no interest rate, no opportunity cost. And the answer was that it would be 80 plus 80 plus 80 plus 80 and 1080. That is 1400. But this value is true if we are living in a hypothetical world where there is no interest rate, no inflation, no opportunity cost, or no required rate of return. But in the real world, you all said correctly that it is going to be less than 1400. Do you all remember this conversation? Perfect. You all remember the conversation? Only one person remember the conversation from yesterday. No other as well. Good. Perfect. But the question is, how much exactly? How much exactly it would be less than 1400? Is it going to be 1200? Is it going to be 1100? Is it going to be 1000? What is the exact value? And for that, we said we have to understand the concept of time value of money. So we'll first understand the concept of time value of money, and then we'll do the valuation of this bond, which gives you the future cash inflow as 80, 80, 80, 80, and 1080. Perfect. Now, in time value of money, we'll understand two concepts, discounting and compounding. Actually, we have to use discounting, but first we'll understand compounding because it is very near to your heart because you have felt it in the real world because you all must be dealing with banks in any certain way. So we'll first understand compounding, and with the help of compounding, we'll understand discounting. Okay. So the topic of discussion for the next 5 minutes is going to be compounding and discounting. Okay, the question with which I'll start is at t equal to 0, you have dollar 100. You all have dollar 100. What would be the value of this dollar 100 after 1 year? After 1 year, if the interest rate per annum is 5%. Any answer? What is the future value of this 100 after 1 year if the interest rate in the market for 1 year is 5%? What do you all think? Great. So you already know the valuation. If you can answer this question, you know the valuation. So 100 after 1 year, if you invest this 100 at a risk-free rate in a bank or FD, how much you will get? You will get 100 into 1 plus 5 upon 100, right? This is what you will do. 100, the future value of 100 would be 100 into 1.05 raised to the power 1. Yes or no? Yes or no? Perfect. Now, if I change the question and I ask you that what would be the value after 2 years, what would be the answer? You would say this 100 after 1 year would be 100 into 1.05 raised to the power 1. Then again, this 105 will be compounded by 5% and will become 100 into 1.05 raised to the power 2. Yes or no? Right? So if I try to simplify or put it in a formula, then I'll say the future value is equal to present value, which is 100, present value into 1 plus interest rate in decimal, or you can simply write upon 100 raised to the power time. 100 into 1 plus interest rate in decimal, or you can simply write upon 100 raised to the power time. 100 into 1 plus interest rate in decimal, or you can simply write upon 100 raised to the power time. 100 into 1 plus interest rate in decimal, or you can simply write upon 100 raised to the power time. 100 into 1 plus interest rate in decimal, or you can simply write upon 100 raised to the power time. 100 into 1 plus interest rate in decimal, or you can simply write upon 100 raised to the power time. 100 into 1 plus interest rate in decimal, or you can simply write upon 100 raised to the power time. 100 into 1 plus interest rate in decimal, or you can simply write upon 100 raised to the power time. 100 into 1 plus interest rate in decimal, or you can simply write upon 100 raised to the power time. 100 into 1 plus interest rate in decimal, or you can simply write upon 100 raised to the power This is the universal formula to find the future value. Yes or no? Do you all agree? Perfect. Now, if I reverse this, if I flip the question, but with one very important theme in finance, in finance, you never keep your cash in pocket. You either invest in FD, risk free rate, whatever you do, you will never keep cash in your pocket. Cash will always be invested at a risk free rate. That is the assumption of finance. Perfect. In that sense, if I say that, okay, there is an amount X, there is an amount X, and the future value of that amount is 100. If the future value of that amount is 100, what is the present value of that amount? If the interest rate in the market, if the interest rate in the market is 5%, what you will do? No hint? Okay. So let's use compounding. If this is X, X will become 100 because of the compounding after 1 year and become 100. Is this statement correct? This is compounding. Is this statement correct? Whatever be the cash flow, that will become 100 after 1 year. How? Because of the effect of compounding. So I'm writing the same formula that you have written here. Are you comfortable with this? Yes or no? Perfect. If this is true, can I say this present value x is equal to 100 upon 1.05 raised to the power 1? Yes or no? So if I flip the question and say what will happen if the 100 is standing after 2 years, then what would be the present value of this 100? If the interest rate in the market annually is 5%. Now you all have to chat. Any answer? But exactly right. But you will write 100 upon 1.05 raised to the power time. This is what you will write. So can I say the formula, the universal formula is this: the future value is equal to present value into 1 plus interest rate raised to the power time. If you need present value, just put it in the denominator. So the present value or PV is equal to future value upon 1 plus interest rate raised to the power time. Now, can you find the present value of all these 80 using these concept? What do you have to do? What do you have to apply? Compounding or discounting? Just chat me. Are we applying compounding or discounting? What we are trying to find out? We are trying to find out the present value. If we are trying to find out the present value, we'll apply discounting. Discounting means division. So we'll divide by the interest rate raised to the power time. Okay. So we have to find the present value of 80, present value of 80, present value of 80 standing at 1 year, 2 year, 3 year. Whatever those value would be, we need interest rate. Do I have the interest rate? Yes, I have the interest rate. That is 7%. And this is a risk-free interest rate. Risk-free interest rate. Risk-free interest rate. Assume the present value of this 80 is going to be 75. 75. I'm giving you the number. What would be the present value of this 80? What would be the present value of this 80? 75 less than 75 or greater than 75? It is going to be less than 75 because it is farther from t equal to 0. It is farther from t equal to 0. So when you will discount, here you will discount 80 upon 1 plus interest rate raised to the power 1. Here you will discount 80 upon 1 plus interest rate raised to the power 2. So assume this is going to be 70. Then what would be this value? Greater than 70 or less than 70? Less than 70? 65. This is going to be 60. This is going to be 55 and assume this to be 900. If I sum the present value of all the cash flow, that will be my valuation. That is what I'm ready to pay today for this bond, which will pay me 80, 80, 85 times and 1000 at maturity. But what is the actual interest rate? What is the actual interest rate? 7%. So can we do the maths? So for this 80, I will write 80 upon 1.07 raised to the power 1. For this 80, I will write 80 upon 1.07 raised to the power 2. For this 80, I will write 1.07 raised to the power 3. For this 80, I'll write 1.07 raised to the power 4. And this is 1080. I have to discount at equal to 0. So I'll write 1080 raised to the power 1.07 raised to the power 5. Can anyone give me this number? Please be fast because it is very easy to calculate all the numbers. 80 upon 1.07. How much is the value coming as? You can use a simple calculator on the phone. I got the value waiting for you all. Thank you, Purav. This is 74.76. For this, you have to just divide 74.76 with what? 1.07. Then the value is going to be 69.87. Then you will divide it by 1.07, which is 1.07 raised to the power 3. Thank you, Anisha. Very helpful. 65.30. I'm writing what Anisha is sending, 61.03, and this value is 846.20. Now, these are the present value of all the future cash flow standing in the future. This is the present value where these values are standing at t equal to 0. And I'm asking the question, how much you're ready to pay at t equal to 0. So you'll sum all the value, what it is coming as. It is coming as 846 plus 61 plus 65 plus 69 plus 74 with decimal places. How much it is coming as? Anyone? The value is coming as, please anyone check. I doubt this value, but still check. 1117.16. This is the present value of the future cash inflow, the summation of this. What is this? What is this value? What is this value? Somebody is saying 1111.09. Which one is the correct value? Need third opinion. Is it 1117.16 or it is 1111.09? Okay. Whatever be the value, what is this value? What is this value? Please, anyone chat. This is what you are ready to pay today. This is what you're ready to pay today to buy this bond. So this is the should be. This is called as should be price of the bond. Or this is called as, in a very simple term, the value of the bond. And what you did right now is the valuation of the bond. Is it simple now for you all to find the value of the bond, to find the should be price of the bond? Yes, no? Cool. Now we'll use BA2 plus calculator. We'll use BA2 plus calculator. Perfect. Before using BA2 plus calculator, there's certain information that you should be aware. The first is you should be aware of the keys, but we already know that face value is what? 1000. How much is the coupon? How much is the net coupon? 80. The coupon amount is 80, 80, 80. What is the maturity? 5 years. And what is the interest rate? Interest rate is 7%. And what you're interested in finding out? You're interested in finding out the present value of the bond. So you have to look for these keys. You will find this key exactly matching FV. Coupon would be written as PMT. Maturity would be written as N. Interest rate would be written as I by Y. And PV would be written as PV. Do you have BA2 plus calculator? If not, then see. Look for this row in your BA2 plus calculator. You have FV, you have PMT, which is coupon, you have I by Y, which is interest rate, you have N, which is maturity. You have to find the present value. That's it. So let's see how we can calculate it. Do you all have your BA2 plus calculator open? Yes, no? First you do clear work, second clear work, second, and then clear work, second clear work. Everyone has their BA2 plus calculator. You cannot sit in FRM examination without BA2 plus calculator. Only 2 people have BA2 plus calculator, others. Anisha, what is the face value? Thank you. So you type 1000 and can you see this key FV? Third row, the rightmost column. FV. Got it? So you have to first put 1000 then FV. Everyone done? Everyone did it? Okay. Next, you have to put down coupon. That is 80. 80 is the coupon. 80 is the coupon. For coupon, the key is PMT. 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 Fourth column, third row. The row is constant. Third row. What is I by Y? 7%. 7. Then you press key I by Y. What is the maturity? 5. N. What do you have to compute? What do you have to compute? Please, anyone, what we are trying to find out? What we are trying to find out? PV, present value. Compute. Can you see the compute key? Top row, leftmost column. Compute. What? PV. What is the value coming as? And that's why I was doubting on the number you were getting. The value should be near to 1041. Why it is negative? Why this value is negative and other value were positive? I'm writing this value 1041. I'm writing this value as 1041. So the actual value, when you sum the value, it will come to 1041. Why this value was negative? And other value that I input was positive. Any hint? Thank you, Nitish. Because this is a cash outflow. Because you will pay 1041 to buy this bond from the market and you will receive 80. That is a cash inflow. 80 is a cash inflow, 1080 cash inflow. But this is going to be a cash outflow. Then you will receive the bond. Make sense? Now I'll pause here. Any doubt? If not, can we solve another question? If not, can we solve another question? Yes or no? If you have doubt, say no. Yes, it should be same rate discounting. Everything should be same rate discounting. Now, if you try to solve this question, I'm moving to the next question. You won't be able to solve this question. So for that, what I'm changing the frequency from semi-annual to annual. Now you can solve the question. Okay. So the face value is 500 and you have to solve the question from BA2 plus calculator, nothing else. Face value is 500, coupon is 6%, maturity is 3 year. Can you please project the cash inflows? Face value is 500. What are the coupons? What are the coupons? Coupon is associated to what? Face value. 6% of what? 500. What does that mean? 30. $30 is your cash inflow. $30 is your cash inflow. And I'm saying that this is annual. So you'll receive 30 net every year at the end of the year. Every year at the end of the year. So 30, 30, and 30. If I don't use the BA2 plus calculator, what I will write the present value of for this one. I'll calculate and you all have to calculate individually. Don't use BA2 plus calculator. 30 upon 1.07 raised to the power 1. What is this present value will come to? 28.03 or 04. 30 upon 1.07 raised to the power 2. Yes or no? The value would be 26.20. 26 point, use 7%, use 7% for the timing. 26.20. 6% I'll use for semi-annual. 530, 432.63. Now please add 432.63 plus 26.20 and 28.04. These are the present values. So plus 26.20 plus 28.04. The value would be 486.88 approximately. And this is the value that we should get from the BA2 plus calculator. So let's jump into BA2 plus calculator. Second clear work, second clear TVM. Second clear work, second clear TVM. Clear TVM is the FV key. What is FV? 500 is FV. Well, press FV. What is the coupon? 30 is PMT, which is the coupon. Maturity is 3. I by Y is what? 7%. What we have to compute? PV, present value. 486.88. It means whether you calculate from BA2 plus calculator or you use the pen and paper and do the summation, you will always reach to the same value. Got it? So you have to recalculate and find this value, 1041. You will get the chat group today as an assignment. What you have to do, you have to solve this question. You have to solve this question, semi-annual and risk-free rate 6%. On pen and paper, you have to click the image and put it in the WhatsApp group. Is it clear? Because you cannot solve this question from BA2 plus calculator. There is something that I have to tell you, and it is related to the concept of interest rate. So you have to change the interest rate from effective annual to effective semi-annual. And for that, I'll also send a video recording of interest rate mechanics, a detailed session of interest rate mechanics. So you should be watching that before Friday. Cool. Okay. With that, I'll pause here.